As the global community continues to navigate the aftermath of COVID-19 pandemic, we have seen an increase in inflation in many economies as demand for goods and services has risen. To combat this, central banks around the world have implemented higher borrowing costs, which can have the effect of slowing economic growth. According to the Center for Economics and Business Research, this could lead to a recession in 2023 as many economies contract. In this video, we will explore the factors that are contributing to this economic outlook and predict the outcome of a potential crisis. So be sure to watch the video till the end. The global economy, which reached a record high of $100 trillion in 2022, is expected to stall in 2023 as policymakers continue their efforts to curb rising prices. This could have serious consequences for businesses and consumers alike, as a recession typically leads to job losses, reduced spending, and increased uncertainty. To mitigate the impact of the recession, governments and central banks may need to implement economic stimulus measures such as increased infrastructure spending or reduced interest rates. It is also important for businesses to adapt to changing economic conditions and for individuals to be financially prepared for potential challenges. There are many potential triggers for an economic crisis in 2023, some of which are already beginning to emerge. The ongoing conflict in Ukraine and increased tensions with China could have serious implications for global supply chains, leading to shortages and prices. Cyber attacks, which have become increasingly sophisticated and frequent in recent years, could disrupt a key infrastructure and have significant consequences for businesses and economies around the world. The financial system is also a potential source of instability, as it remains as fragile and distorted as it has ever been. Despite repeated warnings and opportunities to reform the system since the global financial crisis of 2007 to 2009, regulators have failed to take action, leading many experts to predict that further crises will come. In addition to these external factors, there are also internal risks to consider, such as the high levels of debt in many economies and the potential for asset bubbles to burst. All of these factors combined make it clear that an economic crisis in 2023 is a very real possibility and is important for individuals, businesses, and governments to be prepared. There are growing concerns about accumulation of risks across the financial system, which have often been ignored by regulators and investors only to suddenly emerge. Many European banks are already perceived as weak, and a 2018 study found that off-balance sheet debt levels have increased since 2007. In addition, a recent report revealed that there are $65 trillion in hidden US dollar debt in foreign exchange markets, a much larger sum than before the global financial crisis in 2008, and points to other risks as well. According to the World Bank, since 2000, the poorest countries in the world have spent the highest share of their export revenues on debt service payments to wealthy countries, and debt-related risks are rising in low and middle-income economies as well. While central banks often intervene to stabilize turbulent markets, such as the Bank of England did recently to prop up the government bond market and protect pension funds, a crisis involving multiple jurisdictions and key institutions with unsustainable commitments may not be easily contained. This highlights the need for continued vigilance and efforts to address underlying vulnerabilities in the financial system. Despite the challenges and uncertain global economic environment, the world economy has shown resilience over the past year, adapting to a range of unfavorable shocks including the ongoing conflict in Ukraine, volatile energy prices, and disruptions caused by China's zero-COVID policy. Inflation in major economies appears to have stabilized and may even be trending downward. However, it is important to note that policymakers are operating in a very precarious position, with little room for error. A major economic or financial crisis could still occur if policymakers act recklessly or if a significant geopolitical event were to occur. It is important to recognize that some parts of the world are already facing crisis-level conditions. Low-income countries have been particularly hit hard by rising food and commodity prices, the devastating effects of climate change, and limited access to foreign financing. Even in middle and high-income economies, a range of factors are causing significant strain on the living standards of poor people. If a resolution to the Ukraine war were to be reached, it could have significant implications for global economic stability and potentially lead to increased business and investor confidence. Similarly, if China's exit from its zero-COVID policy goes smoothly and enables a strong economic recovery, it can provide a boost to the global economy. Additionally, if world trade were to suddenly surge, it could also have positive effects on economic growth. Combined with more effective action by monetary policymakers to control inflation, which is a likely scenario based on current central bank forecasts, it is not difficult to envision a strong rally in global equity markets. While there are always uncertainties and risk in the global economy, the chances of this positive scenario occurring should not be underestimated. While there is potential for positive developments in the global economy, it is also important to consider less optimistic scenarios. China's exit from zero COVID could lead to negative health outcomes and undermine economic recovery, posing a dilemma for political leaders. Additionally, Chinese stocks may face challenges due to persistent underlying issues such as high debt levels in property-related sectors. Inflation may also fail to ease as expected, and modest signs of rising wages could become more widespread, leading to higher short-term interest rates. This would likely result in a repeat of the events of 2022 and could potentially lead to a full-blown financial crisis. It is important for policymakers and investors to be aware of these potential risks and to take appropriate measures to mitigate their impact. According to K. Daniel Newfield, Director and Head of Forecasting at the Center of Economics and Business Research, or CEBR, the world economy is likely to face a recession in 2023 due to the increase of interest rates implemented to address rising inflation. The CEBR report also stated that central banks are expected to continue their efforts to bring inflation down to more manageable levels, despite the economic costs, and that this will likely result in lower growth prospects for several years to come. It is likely that the economic growth in developing countries will be driven by a combination of factors, including increased access to education and technology, improvements in infrastructure, and more favorable business environments. As these countries become more developed, they will likely become more attractive destinations for foreign investment, which could further contribute to their economic growth. At the same time, it is important to note that economic growth does not always lead to improvements in the standard of living for all citizens. Inequality may continue to be a significant challenge, and it will be important for governments and other stakeholders to address issues such as poverty and access to health care and other basic services. It is also worth considering the potential impact of global events and trends on the economic outlook. For example, the ongoing threat of climate change and the increasing importance of sustainability could have significant implications for the global economy. In addition, geopolitical tensions and shift in trade policies could also affect the economic landscape in the coming years. China was expected to overtake the US as the largest economy by 2030, but the study shows that that will not happen at least until 2036. It is worth noting that the timing of China's overtaking of the US as the world's largest economy is still subject to significant uncertainty. A variety of factors, including economic policies, global events, and trade tensions, could affect the trajectory of the two countries' economies in the coming years. If Beijing were to try to take control of Taiwan, it could potentially face retaliatory trade sanctions from other countries, which would further delay China's expected overtaking of the United States. It is important to monitor these and other developments carefully, as they could have significant implications for the global economy. Similarly, if India were to become the third $10 trillion economy in 2035 and the third largest economy in the world by 2027 as predicted, it would be a significant achievement for the country. Such growth would be driven by a variety of factors, including favorable economic policies, improvements in infrastructure, and increased access to education and technology. As we approach 2023, policymakers must take decisive action to address the growing problem of economic inequality. If left unchecked, this trend could lead to major crises that could have far-reaching consequences for both individuals and countries. However, by taking proactive and constructive steps to rebuild consumer and business confidence, we can work to ensure that economic inequality does not deepen further. It is up to us to take control of our economic future and make sure that everyone has the opportunity to thrive. Don't let this crisis define our future. Let's work together to create a more equitable and prosperous world for all.